My name is Arira Joseph, the founder of Bluvos Academy. I'm still on the series Before You Buy. I've been talking about the 7 things you have to look out for before you buy the shares of any company. And I've given practical steps on how you can do this. Bluvos Academy is an academy that is dedicated to financial education and also financial empowerment. So we don't just teach you things you have to look out for before you buy the shares of any company and how to buy the shares of company. We teach you on forex trading and crypto trading. Not just that, we empower our traders. Currently, we are partnering with the company to provide $100 each to every subscriber of our channel, YouTube channel. Now, there's a disclaimer for this $100. The first disclaimer is that you must trade at least 30 lots before you can withdraw your profit. The second disclaimer is that before you withdraw your profit or after you've traded your 30 lots, the profit you can withdraw is only $100. The third disclaimer is that because we are partnering with a company for you to receive this free $100, we will not be held responsible in case the company withdraws the $100 from you. If you're okay with that, let's proceed. Before you buy the shares of any company, there are 7 things you must look out for. The first thing is the company's revenue. The revenue of this company you want to buy their shares should be growing consistently for the past 5 years. That's criteria number 1. The revenue of the company you want to buy their shares should be growing consistently for the past 5 years. The next thing you have to you have to look out for before you buy the shares of any company is the company's profits. Let me increase my brightness. Is the company's profits. The profit of the company or the net income of the company you want to buy their shares has to be also growing consistently for the past 5 years. That's checklist number 2. The next thing you have to look out for before you buy the shares of any company is the company's cash flow from operating activities. Now, cash flow from operating activities is the money that a business makes from doing business activities like sales and manufacturing. So this is cash flow from operations or operating activities. Some people call it operating cash flow or cash from operations. So the cash flow from operating activities must also be growing consistently for the past 5 years. That is the criteria number 3. The fourth thing you have to look out for before you buy the shares of any company is the company's economic modes. Now, economic mode is what the company has now that is making them relevant now and will make them relevant in the future. Economic mode, I'll take that again, is what the company has now that is making them relevant now and will also make them relevant in the future. How do we identify the economic modes for any company, any brand? The first thing you do is to look for the industry of the company you want to buy their shares. The second thing you do is to look for the companies that are in that industry. So apart from the company you want to buy their shares, after identifying the industry of that company, you look for other companies that are in that industry also, other players in that industry that sell shares. The third thing you look out for is that for all these companies that are in this industry, you identify their revenue for the past 5 years, whether it's going consistently. You identify their profit for the past 5 years, whether it's also growing consistently, their cash flow for operating activities for the past 5 years, whether it's also growing consistently, and their number of customers. So the company that has the greatest number, that is the king of the industry. So now that we have identified the king of a particular industry, the next thing you want to look out for is whether this king of this industry currently will still be the king in the next 10 to 15 years. So what you look for is the current technological innovation that this company is working on. That is what is going to position them to be the industry player in the near future. So if you have gotten that, let's proceed. The next thing you have to look out for before you buy the shares of any company is the company's current ratio. Now, current ratio is current asset divided by current liabilities. It tells investors whether a company will be able to pay their short-term debt. So if the value is less than 1, it means this company you want to buy their shares will not be able to pay their short-term debt, so you can avoid them, you can leave them, or you can put them in your wait list. But if the value is equals to 1 or greater than 1, it means this company will be able to pay their short-term debt, so go ahead and buy their shares. The next thing you have to look out for is the company's returns on equity. Now, what is returns on equity? Returns on equity is the company's net income divided by shareholders' equity. So if the value is less than 10%, you should avoid this company. This is our own standard. There's no industry standard for Business Academy. If the value is less than 10%, this company is not worth buying, because we want to invest 1 million naira, and after a year, 100,000 naira should be added to our 1 million naira. So our benchmark is 10%. The next thing you have to look out for before you buy the shares of any company is the company intrinsic value. Intrinsic value of a stock. Now, why do you have to look for the intrinsic value? An important question to ask here is, what is even intrinsic value? Intrinsic value is the real share price of a company. So to know the intrinsic value of a company, you must use an intrinsic value calculator. So our premium student gets the intrinsic value calculator to calculate the real share price of a company. So why is it necessary to know the real share price of a company? The real share price of a company will help you know whether a company is overvalued or undervalued. And the reason we have to know whether a company is overvalued or undervalued is because a good company can be a bad investment if you're buying this company shares at the wrong time. I'll take that again. A good company can be a bad investment if you're buying the shares at the wrong time. So what then is a good company? A good company is a company that is growing consistently for the past 5 years. The revenue is growing consistently for the past 5 years. The profit of this company is also growing consistently for the past 5 years. The cash flow from operating activities, operating cash flow, is also growing consistently for the past 5 years. The economic moat is strong. They have a good sustainable economic advantage, strong economic moat. Their current ratio is not less than 1. Their returns on equity is not less than 10%. So these are the qualities of a good company. So if you find a good company, you find an oil well. So the reason we have to go over to look for the intrinsic value is to know whether this good company is selling at the right price. The right price is when it is undervalued. That means when the intrinsic value is greater than what is quoted in the stocks market. So if you have gotten this, we are heading towards the practical section on how you can identify a good company in the stocks market for long-term investment. If you're ready, say hi. I just heard you say hi now. So let's proceed. So the first thing you look out for, or the first thing you do, is to use your Chrome browser. And in your Chrome browser, you open a new tab and you put the web app we'll be using is investing.com. Click on search. So to the top right of this website that is opening, there's a search icon, a search bar. Top right of investing.com. Okay, our website is still loading. No need for all this stuff. Let me close out. Oh, the option to close out is not available. So let me just click on that top right. Which companies we research on? Let's say we want to buy the shares of Airtel Africa. I'm coming. Okay. Oh, let's close out from this app. This advertisement that's popping up here. Okay, Airtel Africa. What's showing out here? Bahati Airtel. No, this is not what I'm looking for. Airtel. Airtel. Yeah, Airtel Africa. As just scroll down to the end, Airtel Africa PLC, stock Lagos. This is what I'm looking for. So for Airtel Africa, their share price is 2,541 naira 50 kobo. So let's do research. Let's research this company. Let's look for their revenue. What's this pop up now? And it's not as if it's giving me option to close out from the app. Let me research. Let me go back to my website. Okay. Click on financials. So I'm looking for the revenue of Airtel Africa. So they only have from 2022 to 2025. Okay. This revenue. Let me scroll down to the end. You can see in millions of USD. Except per share item. Oh. It looks like currency in NGN. So it's 25 naira, 2,541 naira 50 kobo. So in millions of USD except for per share item. So you multiply each number here by 1 million. So for 2022, the value is 4,724 times 1 million is 4,724,000,000. So that's a revenue for 2022. For 2023 is 5.2 billion. 2024 it dropped to 5 billion. 2025 it dropped to 4.9 billion. So they've just had only 2 years of consistent growing revenue. Let's go to net income and see this net income. 2022 they had 631 million. 2023 they had 663 million. 2024 they lost money. They lost over 165 million. Yeah, 165 million. 2025 it rose. It was okay. 220 million was their profit. So we go to cash flow from operating activities. This is it here. So we'll go back to look for the year. Okay, 2022. 2022, their cash flow from operating activity is for 2022 was 2 billion. 2023, 2.2 billion. 2024, yeah, 2.25 billion is increasing. 2025, 2.26 billion. So they have a consistent growing cash flow from operating activities for the past 4 years. Based on the record report that's showing us just 4 years period. So for 4 years, their cash flow from operating activities has been growing consistently. But for their net income, it only grew consistently for 2 years. They lost money in 2022, 2024, and it could not rise above The value for 2025 could not rise above that of 2023. So the next thing you want to look for is the returns on equity and current ratio of Airtel Africa PLC. So we'll click on ratios, still under the financial tab, we'll click on ratios. Okay, it's opening. Thank God for opening fast. Hello. What we are looking for is the returns on equity for Airtel Africa PLC. Under management effectiveness, if you look where you can see returns on equity, to the right of it is 17.3%. This TTM stands for trailing 12 months. So from last year October till this year October is 12 months. So their returns on equity is 17.3%. So the next thing we have to look out for, and 17.3% is higher than 10%, because 10% is our benchmark. So they have somehow met criteria based on the returns on equity. We'll go back to current ratio. Current ratio is under financial strength. The current ratio for Airtel Africa is 0.5. This MRQ stands for most recent quarter. Most recent quarter means October, September, August, July. So the most recent quarter for their current ratio is 0.5. And our current ratio, we say, should not be less than 1. So for Airtel Africa, the value is 0.5. It means this company, 0.55 means this company will not be able to pay their short-term debt, because their debt is higher than, their liability is higher than their assets. Current liability is higher than their current asset. That's why the value is 0.5. So they will not be able to pay their short-term debt. So Airtel Africa, if you look at it intrinsically, it's not a good company because it has not met our criteria. But that being said, let us check Airtel Africa intrinsic value, whether this price 2541 is the right price for Airtel Africa. So how do we do that? First, we have to go back to our intrinsic value calculator. And I told you that calculator is for only our premium students. So it's opening. Let it open. Yep. Okay, just loaded. So what we are going to do now is to put in the name Airtel Africa PLC. Free cash flow. We'll go back to we're looking for the free cash flow of Airtel Africa. So under financial tab, we'll click on financial summary. We'll scroll down. We're looking for the free cash flow for Airtel Africa. So under cash flow, you can see where they say levered free cash flow. So we'll scroll down to the year 2025, and the value we have here is 946.75 times 1 million is 946 million naira as the free cash flow. So we'll go back to our calculator and put 946,750 then 000. That's the free cash flow. Remember, Airtel, their returns on equity is 17%. Now, period. What do we know about period? The reason why period is here in this calculator is because what we are using, the method we are using to calculate the intrinsic value of a stock is the discount cash flow method. And in the discount cash flow method, we try to estimate what will be the worth of a company in the future based on their free cash flow. When we know the worth of a company based on their free cash flow in the future, we are going to divide that by their current outstanding shares. It's going to give us the intrinsic value of a stock. So that time in the future is what is called period. So for us, and they want to use like 15 years from now, what is going to be Airtel what based on their free cash flow 15 years from now. And that time in the future should not be less than 10 years. So from 10 years and above. So our own, we are just putting a value of 15 years. Then we'll come over to outstanding shares. The outstanding shares of Airtel, we are going to go back to our investing.com and look for the outstanding shares for Airtel. So how do we do that? We scroll up, we click on general, we allow it to load. It's loading. Okay, it has loaded. So now that general has loaded, we'll click on ownership. We are looking for the outstanding shares of Airtel. Now, outstanding shares is how many parts Airtel PLC, Public Limited Liability Company, has been divided into. That a part is now going for 2,541 naira 50 kobo. So we want to look for the number of parts Airtel has been divided into. So we'll scroll down. Okay, it's still loading. Ownership is still loading. Oh, wow. Okay, this is common stock held for Airtel Africa. So the common stock held for Airtel Africa is 3.65 billion. That is the number of parts Airtel has been divided into. Airtel Africa has been divided into is 3.65 billion parts. So we'll go back to our calculator and put 3650, then put 6 zeros at the end. 1, 2, 3, 4, 5, 6, 6 zeros. Then what's the share price of Airtel? 1,400. Let's go back and check our investing.com website. Okay, 2,541 naira 50 kobo. Airtel is going to be an overvalued company. I've just seen it. 2,500 and is it 41? 2,541.50 kobo. Okay. 2541.50. So now that we have imputed all the values, we have put the name of the company, the free cash flow, their returns on equity, the period in the future want to know the worth of Airtel based on their free cash flow. We have imputed their outstanding shares. We have put their share price. We click on calculate. Wow. The intrinsic value of Airtel Africa PLC is $14. This calculator is built using dollars, so but the currency of Airtel is naira. 14 naira, and it is 18,303% overvalued. So not just only as Airtel Africa not met a criteria of a good company, it is an overvalued company, so you can avoid them. My name is Haruna Joseph. I am the founder of Blue Voice Academy. As usual, take charge.